Things here. Okay, we are live. Hello, everyone, and welcome to an update on Rebel Finance School 2024 and also an Ask Me Anything session. So, hello to everyone on Zoom. It is lovely here to have you. Hello to everyone on YouTube. Al Gardner's here. Kay, Steamy, Adam's here, Chris, Karen, Fiona. It's so lovely to see you all here. Thank you. I've got YouTube on my phone so I can see the questions, and it's currently playing me an advert for my own live stream, which you have got to love. So, hello, everyone. First, let's go with the big news. Katie and I have finally decided on a date for Rebel Finance School 2024. We will be running it from June the 10th this year. So it'll be every Monday night for 10 weeks as normal. Obviously, we're going to work at enhancing it. But I think the biggest change that will be this year is Katie and I are going to do 2 live streams a week, and we're going to separate out the questions. Because I think we all got a little bit exhausted when the YouTube lives went for 3 hours, and we were trying to answer very complex tax questions at the end. So we're going to do Monday night will be the content, and we'll deliver the content, we'll connect with you all. And then Thursdays, we're going to do the live questions and answers. So we're going to do it as a live stream, so it's recorded. You can email us your questions and we'll answer them live, or you can come on the Zoom and chat to us and we can do all that then. So that's the plan on those 2 bits. Plus, we are planning some new bits. You know, week 8 is all about tax advantage accounts, SIPPs and ISAs and all that stuff. And it's the week where our incredible friends from New Zealand go, how does this apply to me? And the Americans go, what's a SIPP and what's an ISA? And we go, it's a 401k and a Roth. Well, this year we're going to have 2 separate sessions. Ruth from the Happy Saver has agreed to come on Rebel Finance School and tell us all how it works in New Zealand. So she will be doing a New Zealand slot, and Brad from Choose FI has said he will come on and translate British English into American for all of our American audiences, which is fantastic. So I am super excited that we have both of those things coming. So that is what is happening for this year, which I'm really excited about. You can sign up now if you want to. The sign up page is done. Katie helped me do that before she disappeared off to her 2 retreats. And you can tag yourself for that, or share it with your friends, your neighbors, your dogs, anything you would like. And yes, the Rebel Finance School is fully global. We had 43 countries last year, and about 7,000 or 8,000 people a week. The biggest 2 nations other than the UK were the USA and New Zealand. So shout out to everyone in New Zealand and America. So it's a fully global program. Is a fully global program, which I'm super excited about. Yeah, so before we move on to the other stuff, which is all your questions, which I love, I've captured every single one from YouTube, Facebook, and your emails. Before we move on to those, is there anything you want to know about the course, what's coming up, what we're planning? Because the Rebel Finance School will be the 10-week course, and we'll come on to it in the questions because lots of you asked about pensions and drawdown strategies. Katie and I are actually planning a second course later in the year, which will be specifically on drawdown strategy and what do you do when you actually get to the end of your accumulation phase, not the end of your life, the end of your accumulation phase, and how do you actually get money out the other end? Because that seems to be some of the biggest questions we get. And we know that's not covered in the Rebel Finance School as much. Like, we cover little bits, but not that much. Cool. So no one seems to have put any questions about this year's course, which is good. That means you're all happy. So questions. You can feel free to put your questions in the chat. You can feel free to wave at me, throw something at me, do whatever you want. I don't have Katie with me tonight. She's on a silent meditation retreat. So she's not allowed to talk, gain eye contact, I'm pretty sure YouTube lives were on the list of things you couldn't do as well. So she's not here to help me with the questions. So if I miss one, please do put it again and I will come back to you. Okay, right. Let's go with the first question, which is from Garimpo on Facebook. He said, "Hi, Alan, thanks for all your videos. I have a question. At the moment, I'm only invested in the 100% in the Footsie Global ex-UK index fund. I would like to buy some bonds to keep my portfolio balanced. What kind of bonds is good for this purpose? Please provide some insights. Thank you so much. By the way, I'm from the UK." So, normal disclaimer, I'm not a financial advisor, but I can help in many ways. I asked Garimpo back how old you are, and that's one of the key questions, because for us, when you're in the accumulation phase, you're earning money and you're using that money to invest, you don't need bonds. Bonds are designed, well, they're not designed for this. They're used by this for the financial independence community to add something that you can rebalance against when you get towards retirement. But if Garimpo is 39, and I'm assuming he's going to be earning money for quite a few years to come, he does not need bonds in their portfolio. What that will do is drag down your performance and mean you are working longer, because bonds always underperform what the market does. So that's the first question. Kate says she's looking forward to consolidating what she's learned from last year and filling in the gaps. We've gone straight into bonds and stocks and shares questions. So you know it's going to be a good night when we do that. You know it's going to be good. D says pension advice is limited and complex. I've contacted the agencies that are supposed to give you advice and they were rubbish. D, that's why we're here. That's the only reason we have a job. If those agencies did what they were meant to do and actually helped you, we wouldn't be here. But we're going to work through all of this. Raj says, "Hi, Alan. I'm 52, but still thinking of keeping it in high risk, my stocks and shares pension." Like, I think the way to look at this, Raj and everyone on the call, is not about age. It's about, are you earning money or are you not earning money? So it's, are you in the state of bringing in money and investing? If you are, we would be 100% in stocks and shares. If you're coming to when you want to transition to living off your portfolio, you may want to introduce some bonds, but that's when you're living off it. You don't need it when you're accumulating. And the reason I do that is because some of you might retire at 50 and then go back to work later. Some of you might change, and it's become a lot more fluid with ages. We're no longer in the stage where we all retire at 68. It's changed. So think about it as when you're accumulating or earning money, you want to be in stocks and shares. And when you're not, then you might want to introduce some bonds. So that makes it a lot simple. Okay. Viola says, if you were put in bond funds years ago by a well-meaning advisor, how can we sell out of them without too much of a tax hit? We're in the US and this tax is accountable. Speak to that well-meaning advisor and say, how do I get out of this? How do I sell it? And we just need to calculate the tax on it and work it out. And when we first started, did exactly the same. The advice was to have a mix. We bought bonds, then we got into the FI world and realized you don't need them at all when you're in the accumulation phase. We sold them off and then had to transition to the other bit. But there's no quick and easy answer to that other than speak to the advisor or speak to your accountant and work out what the tax is. Perfect. Okay. Hilary Benenson said, help RE approaching early retirement would be helpful to better understand implications for investments, ISAs, and future pensions. Hilary and everyone, I am definitely planning on doing a full series on the drawdown and what happens afterwards towards the end of the year. So I'm going to provide that support. I'm going to create that with Katie. I need her back from the silence retreat because she's quite good at this stuff. So we're going to do it together. We're going to create it, but that will come after the after the Rebel Finance School this year. Okay. Mark Petherbridge says, do you believe that there is a benefit from doing this course again if you did last year's course? Mark and everyone listening, the course will be enhanced. Is there a benefit to do it again? Depends if you think you've got it nailed. Maybe you just want to watch a couple of sessions for motivation or to catch up on the latest tax stuff. You will always get something out of it, but maybe if you've done the course before, choose which sessions are most exciting to you and then just come to those ones. Okay. Moving on, Sarah Jane on YouTube says, any capital gains tax advice? Completely alien to me, but just about to sell an asset and be charged capital gains tax. Capital gains tax is not my favorite thing, but it exists. We do have to pay it. It depends on the asset type you are selling. There are different bands or rates for property versus stocks and shares, which is why Katie and I always go on about using your tax advantaged accounts, ISAs, SIPPs, 401ks and Roths as much as you can, because things in there are protected from capital gains. So you don't have to pay that tax. The simple answer for this one is the .gov website is actually very good. Yes, you heard me correct. I am complimenting Her Majesty's Revenue and Customs for their website. It has some great thought out examples. So whenever Katie and I just need to work that stuff out, we just go to the .gov website, work through the examples, and we go from there. Yeah, that's it. There's not much to it other than that. The bit that gets really complex is if you bought stocks and shares in a general account, and then you have to work out your capital gains tax on that. We had one question on that in the emails this week. It's so complex, Katie has built a bespoke spreadsheet to deal with it, which I put it down in the list of things to speak to her about. I think we'll do a special workshop on it and give you the spreadsheet to work it out. So if that's you with a general account, we will work that out with you. We'll send you a spreadsheet and we'll get that sorted. It is a big challenge to do that one, which is why we always come back to don't do it. Just invest in ISAs and SIPPs, and you can invest 60 grand a year in a SIPP and 20 grand a year in an ISA. And if you've got more than that, well, you're doing well. We'll figure it out as we go. Okay. Raj says, I'm still confused if I should consolidate my pensions from previous employers. The highest charge on one of them is 0.9% and the rest are lower. So the answer for everyone here, if you have multiple pensions from different employers, it comes to the fees and is it any good? So Raj said the highest fees are 0.9%. That's really high. A Vanguard SIPP is 0.15% that is capped, plus the fee on the fund. So Raj, that is really high. I would consolidate that into a Vanguard SIPP instantly. And then I would check the other pensions and see what the fees are and what you're invested in. Because if it's a reasonable fee and they've got good funds, i.e. you can get a broad-based global tracker, then you could leave it there. There is something to be said about the simplification of all of that old stuff into one pot that does make you feel good. So yeah, you could easily consolidate it into a Vanguard SIPP or something like that. Let me know if that helps, Raj. Perfect. Nisa says, do stock markets tend to go up during an election? Oh, there's a crystal ball question, isn't there? Derek's smiling. He's like, how's Alan going to deal with this one? He's going to make some stuff up. I'm actually going to tell you a very quick story of me. Back in 2015, it was heading towards Brexit and it was heading towards Donald Trump being elected. And I was nervous. I was like, I don't know what to do. So we actually kept a large chunk of cash on the sidelines out of the market because I was scared. This was very early on in my investing career. I didn't know what to do. We ended up going to Chautauqua and meeting Mr. Money Mustache and J.L. Collins and all the others. And their advice was just get it in the market as quickly as possible. The reason I was scared is I thought that if Trump got in, the market would crash because he's a bit crazy. And if Brexit happened, the market would crash because it was Brexit. And actually, the exact opposite happened. When Trump got in, businesses thought he was pro-business, so the stock market surged. When Brexit happened, our currency crashed, which meant lots of the British companies were selling abroad and they were earning more money, so the stock market went up. Funny how these things happen, and who could have predicted it? I couldn't have predicted it, and I actually missed out on lots of growth by keeping my money on the sidelines. The answer is no one knows. So you just need to get your money in the market as early as possible and let it grow. The saying that we always repeat, which I'm sure Derek and Jack will mouth along with me, is time in the market is more important than timing the market. No one can know the answer to this, so just get it invested. How did I do, Derek? Was that okay? Derek gave me a thumbs up. I haven't messed anything up yet. Okay. Let's go to the next question on this. Polly says, I'm struggling to consolidate my pensions from previous employers. Would I be able to find them? Yes. So there is a government service to help you find old pensions. Just be a little bit wary, because they will help you find your old pensions and then they will try and sell to you. So my business partner, Simon, used the government service, and he was sent a St. James's Place advisor to help him find his old pensions. And then that St. James's Place advisor tried to get him to invest with them. So use them to find your old pensions, and then do not use their advice afterwards. Derek is wonderful. He's put the link in the chat. The second thing, I actually did an experiment this week. ClearScore is a credit rating agency. Don't particularly like them, because if you sign up to them, they will just try and sell you loans and put you into debt. However, they've just introduced a new service to help you find old pensions. And I put in my details just to see what it would come up with. It's not found anything yet, but that might be worth having a go. The same caveat is, do not trust the advice that comes afterwards. They're going to try and sell you something. So any free service to help you find pensions has to be funded somehow. They have to make money somehow. So use their free service and then think what you actually want to do with that money. Does that answer it okay? It's always funny when I'm just speaking to you all and there's like no responses. I can only see a few of you in the chat. So like a few of you say yes. Polly says yes, that's great. Bella put her hand up for a second, which I think she didn't mean to, because she then hid afterwards. Okay, so moving on. Chris Seaver on YouTube says, do you have a list of the weekly course titles, subjects? Apologies if you've already posted this somewhere. Chris, no worries. Just rebelfinanceschool.com will auto link to a page which gives you the outline of the different weeks, and you can find all of the different pieces on there. Okay. Alon Elves says, should we be concerned with the AI bubble right now? Nvidia et al.'s valuations are bonkers. If they deflate, we all might take a hit, even if we don't hold those stocks directly, but via ETFs. Alon, you're right. We all own a bit of Nvidia and some of those different stocks right now. And I want to say, Alon's question is predicated on the belief that we're in a bubble. How do we know we're in a bubble? We don't. Like, we've seen the market go up November till March, and then it's come down a little bit, which is standard. The market just goes up, then down, and then up, and then down, and then up, and then down. But over the long run, it always goes up by 10 to 12% a year. So do you know whether we're in a bubble or not? We just don't. Ever since I started investing way back in 2015, everyone says the market's at an all-time high. It could never go any higher. And it's like a repeating story every year. And I always laugh, because a year or two later, it's always higher, and then higher, and then higher. And this always comes back to, It's going to go down at some stage, and we just need to get used to riding those waves, and then it will go back up again. That's how the stock market works over the long term. If you're buying a broad-based index fund or ETF, it is not the same for individual shares. So are we in an AI bubble? Who knows? Who cares? Time in the market is more important than timing the market. Get your money in now and allow it to grow over the years, because you'll be looking back going, oh, the prices of, like, in 5 years' time, you'll be looking back and going, the prices of those shares were so cheap in 2024. So like, just buy the stocks and shares as you go, invest your money as quickly as you can. That's how it works. Okay. I'm just scanning down. Brett says, what causes the markets to fluctuate? Brett, that is a fantastic question. The people I can see on the chat are smiling because it's like, what causes the market to fluctuate? The answer is humans. Humans cause the market to fluctuate. A global thing happens. Everyone panics and sells off the shares. The price collapses. Basically, let me use an analogy for you of a pint of beer. So imagine a pint of beer. Dee, imagine a pint of beer for me. There's the actual beer, and then there's like the froth on top, the head. If you imagine the actual beer as the actual value of the companies, it's the good bit. So these companies are out there trading, making profits. We own Microsoft and Apple, and they sell phones to people like me. They sell computers. They make money. They generate the profit. Then the froth on the top is like the speculation or the confidence. So sometimes people are very confident. They throw all their money in. Prices surge. Sometimes confidence goes down, like when there's a war in Ukraine or something happens, and then that like froth shrinks. The underlying bit is always there because those companies are profitable, they're making money. People will always buy phones, they will always buy food, they will always do these things. So yeah, that's kind of the main bit on that question. What causes the markets to fluctuate? Confidence, humans, global events, and fear. Fear, people withdraw their money in fear because they get afraid, and then they think, oh, I better take my money out of the market and put it under a mattress, keep it safe, because gold bullion is obviously better than owning companies. And then the markets crash, and then the rest of us buy up the stocks and shares, and it goes back up again, and we're all good. So that, I think, answers that one. Derek, you leant in like you were going to say something. No, he wasn't. Okay, he was maybe getting comfortable. Okay, Chris Andrews, I think, is flirting with me by message, which I love. He says, "Hey, Alan, you're looking great. Thank you. Been working out. You mentioned in the past that you retired with 1 million and have since continued to accumulate since. Yes, I think I can tell you all, like, we've just hit 2 million invested, which I never could have imagined. And that's the power of compounding. It's insane. Compounding, in the early years, you won't feel like it's doing anything. In the latter years, you'll be like, holy moly, how did this happen? I have no idea. So building on that, Chris says, in retrospect, do you think that if you're pulling the trigger in your 30s, 40s, and 50s, it's worth doing so before you reach your total fire number instead of slogging it out to the finish line? This is something Amber, my wife, and I talk about for our own plans as we anticipate making more money in the future with other projects and side gigs. The answer is most people are too cautious. So most people go way past their number and then have fear about retiring. Having been through this, I feel a lot more confident about the maths of the 4% rule, and I actually think it's quite conservative. I feel a lot more confident about how it all works. I could have retired a little bit earlier because I kept making money, and I, like, who knew? I guess the questions for all of you are, if you're thinking about that retirement bit, is do you actually never want to make money again? Because if you're the kind of person who's saved up enough money to get to that financial independence space, you're probably going to make some money through side projects, through something by mistake, which when I say that, I know someone's going to go, how do you make money by mistake? You're just going to have an offer. Something's going to happen. Like it's very difficult to not make money if you're smart enough to figure all this out. Um, so you could definitely do it a little bit earlier if you wanted to. Um, it just depends on you and how much you want to work. Some people want to get to the number and never have to work again, never have to think about it again. If you're willing to be a little bit flexible in retirement and do a little bit of work if the market goes down for a year or travel somewhere cheaper for a year, then you could absolutely do that. Yes. I hope that helped, Chris. Let me know if it did. Angela Campos says, I look a little bit like Tintin today. Yes, I actually did my hair for once. It doesn't happen very often. Okay. Ben O on YouTube says, how to invest more than 20K, let's say 50K, when you have no ISA to shelter it in. The answer to that is, so two pieces. One is lump sum investing nearly always trumps what's called dollar cost averaging, which is where you put it in the market a little bit each month. So let's say you sold a house, got some inheritance, you had 50K. Putting that 50K in a grand a month for 50 months is the worst way you could do it. Investing the whole lot in one go is the best way you could do it, but it takes a bit of confidence. Second point is, I can't put it all in ISAs. That is correct, but you can put 20 grand in ISA and then you could put the rest in your SIPP, and then it's all tax sheltered. If you don't want to use a SIPP, which seems crazy because they're a tax advantage account, then you could put your 20 in an ISA. You could put the other 30 in a general account, and then you'll end up doing what Katie and I do each year, which is the general account grows, you sell off 20 grand of it and then put it into the ISA the next year. It's called bed and ISA, but you have to work out your capital gains and profit, and then you have to pay tax on that, which is a little bit confusing. I would definitely lean towards ISAs and SIPPs and using tax advantage accounts. It makes everything so much easier. Raj says, or MSI premium bonds. Raj, I would not use that as an investment vehicle. You can use it for your emergency fund, but what happens is people get addicted to the fact they're winning £100 a month on premium bonds, and then they like want to put more in premium bonds and they get addicted. How do I know? Because I have done that. And so many of our friends have done it. Then they don't want to sell off their premium bonds because they're addicted to £100 a month. But they would have been making like £1,000 a month in the market. Is a completely false economy. So premium bonds, great for emergency funds, not great for anything else. Cool. Awesome. Bella says, hi, Alan. Please, do you know anyone who is pursuing FI with kids? It's tough out here on these streets. I'm struggling with being a present parent, building career and chasing FI at the same time. Bella, I could understand that. That feels like 3 full-time jobs as you go. Do I know anyone who's pursuing FIRE with kids? A huge number of people. A huge number of people. In terms of writers, Mr. Money Mustache has a kid and has written a lot about it. Mr. 1500 has 2 kids and has written a lot about it. Go Curry Cracker has kids and has traveled around the world with him and written a lot about it. Chris Andrews in the chat says, we have a 17, 15 and 7. So there's actually lots of people in the group who've been doing it as well. And I recently saw a post in the Choose FI group, which I'm sure you can find. It was from a single mum who just hit 1 million invested. So she's just past 40. She's hit 1 million invested as a single mum. And like, it is possible to do it. I know you can. I know it's a challenge. And I just want to say, it's not going to be easy, but it's possible. And I believe in you. And there are a bunch of people in this group that will help you. The Rebel Finance School community is incredible. I am so proud to have you all as friends and the way you all support each other. So if you want motivation, post a question in the group, share it with someone else. I will share ideas. I don't have kids, but I'm quite good at coming up with ways and ideas to help. But those writers do have a lot of them, and there are a huge number of people to do that. Cool. So the questions are going very, very quickly here. Aaron Dawkins says, as you have mentioned that you have used a SIPP, meaning only part of your FI number will be outside, do you wait until you had your FI number in accessible accounts or draw less than 4% until access? So that's a great question. What Aaron is asking is, how do I think about all of my different pots because I can't get to them at different ages? So some of us are thinking, well, at age 68, I'm going to get the state pension, which is like 10 grand a year. At age 58, I'm going to get access to my SIPP. There's all those different pieces there. The way we think about it is, number one, think of it in total. Doesn't matter when you can access it to start with. So the total number. So if you want $1 million invested to live off 40 grand a year, that's what you're going for in SIPPs, ISAs, general accounts, the whole lot. If you've got it, you've got it. Then you can take your 4% of the whole amount, but you might take it from ISAs first. So you don't have to think I can only take 4% of what's accessible, because you've got the whole pot there and the other amount will still be growing over the years. The only question is, will your ISA last until you get to your SIPP? And will your SIPP last until you get to your state pension, which is the second piece? So you think about it as a whole, then the second piece, I would do our financial forecasting website and build your own little spreadsheet that says I can use my ISA to this date and it'll last. I'll use this to this date. That's how Katie and I did it. And the financial forecasting workshop will show you all of that. Just go on our YouTube channel, search financial forecasting. It's the workshop that I have most sent out to people today, answering all their emails and answering all their questions. So have a look at that one. Cool. Right. I hope that helps, Aaron. Please let me know if it did. There's someone here called Student that says, at what PE ratio, which is price earnings ratio, will Tesla be a good buy? How to determine if a stock is currently overvalued or undervalued? Does same apply to ETF? So I'm sure you all know this. We don't recommend individual stock pecking. We don't recommend anything because we can't. We're not financial advisors. But we would never do stock picking because basically you're betting that Tesla will do well. We don't know if it's undervalued. We don't know if it's overvalued. We don't know if the price earnings ratio is good or not. You basically can't unless you're a true industry insider. And even then, most of them get it wrong. Just don't buy individual stocks. Buy a broad-based index fund, and you're buying all of the companies in the market. So the student on YouTube, we would say never do that because you're basically guessing which stocks are going to do well. Don't buy the whole market. If that doesn't make sense to you, please come on the Rebel Finance School because we spend 3 sessions doing all about investing, the different ways to invest, and stocks and shares and all those pieces. I can't explain it in like an hour's YouTube live, but in 3 sessions we will get you there. So we say don't do that. Just, it's not worth it. Avoid it. Excellent. Okay. Raj says, do I have any recommendations on which MTD software to use? Raj, what is MTD? Does anyone know what MTD is? Microsoft Total Donkey? I don't know. Making tax digital. Okay, cool. Got it, Raj. Thank you. So this is for your business, I assume. Um, I don't really have any recommendations. Dee says she uses Zero. We use Zero as Rebel Business School. There are some free ones as well. I know Metal is free, and we've used that with one of our other businesses. So those are both great. Okay. Rachel says she likes my answer on the 4% thing. That's fantastic. She also says she likes the financial forecasting workshop. Awesome. Ben says, Alan, what's your view on owning property to live in? I understand you don't own one now. Yes, Ben and everyone, I am homeless and unemployed. I don't own anything with keys whatsoever. Um, my opinions on property to live in, there are two elements to the decision. Number one is maths. Number two is emotion. So there is some maths to go. In my area, is it cheaper to rent or cheaper to buy? We actually did the sums after living in Basingstoke for 10 years, and it would have been about the same whether we rented or bought. So taking everything into consideration, all of the costs, all of the money we spent on the mortgage, uh, if we'd have invested the deposit instead of buying the house, like all of those elements, it would have been roughly the same. Then it comes down to emotion. Do you want to be a homeowner? Does that do you feel good? Do you feel proud? Um, and are you willing to pay the price to do that? If so, that's great. Buy the house. We always just say know the maths behind it, because most people take financial decisions based on emotion without actually knowing the maths. So if you know the maths and you're comfortable, then that's it. Um, we have chosen to become nomadic and rent because we want to explore the world for a little bit, and I'd rather not spend my hours fixing home stuff. I spent a lot of time doing that. I don't need to do that anymore. Perfect. Dee says, I'm a homeowner, but make it work with Airbnb, a room at the 7K, 7.5K annual tax-free limit. Dee, I love that. The spare room allowance is fantastic. That is a great way to do it. Kate Douglas says, do you guys still have a big lump in a general investment account? We have a fair lump in it as I can't do a SIPP at the moment, maxed out on workplace pensions as a higher rate taxpayer. So just doing ISA and general account. That's perfect, Kate. If you've used up your allowances in SIPPs and ISAs, then definitely get it in a general account. It's better to have it growing than not. And capital gains tax for a higher rate earner on stuff you sell off stocks and shares is only 20%. So it's actually quite a low rate, which I've actually come to realize that general accounts are actually quite a low rate of tax. So stick it in the general account, do it. And yes, Katie and I still have a rather large chunk in our general account because we sell off to the maximum capital gains free allowance every year and then put it into ISAs. And it keeps growing faster than we can sell it off. First world problems. I know you're probably all shocked and thinking, oh, Alan, we're so sorry for you that your money's growing faster than you can sell it off. But that kind of is what happens. So there we go. I think that's an answer to that one. Kath says, hi, property rich, cash poor, high debts, etc., ill health, but coming up to wanting to retire on a small teacher's pension at 60. So no investments, any suggestions? Kath, number one, come on Rebel Finance School. Like, go through the course if you haven't, because I think that will help you think it through. Number two, the biggest challenge people have got when they're like property rich is you cannot live off the house that you are in. The most extreme example of that, we had a friend who bought a flat. It was a gorgeous, huge flat. He bought it for not a lot back in the 80s in an area of London that has since been redeveloped. His flat is now worth £3 million, but he wants to live in it. So he has to still keep earning because he wants to live in it. But if he sold that flat and put all of the money in the market, like he'd obviously have to pay some tax, but he could get like probably 2.5, 3 million in the market. That gives him nearly 120 grand a year of passive income to live on wherever he wants. So my question to him was, do you want the flat or do you want 120 grand a year to live on? Which would you like? And it's not binary. You could rent it out. You could do other things. You know, Katie would be screaming, it's not binary. But I think sometimes making it binary helps people to see the decisions they make. So if all of your money is locked up in a property, you have a choice. You can either get some of that money out and put it to work for you by downsizing or doing something different, which Adam Rowe, who's in the group, did that. He downsized, he put his money to work, and he talked about that on one of the recent events. Very interesting to see. Or you can say, I definitely have to live in this house. And then, well, we need to say, well, you might need to work longer, get your pensions in a different way, do something else to cover the gap. So there's a choice that has to be made from where you are now, and the course will definitely help you do that. Awesome. Okay. Tracy Littlejohn says she's interested in changing later on to having more bonds and less stocks and shares. She was talking about the traditional 60-40 split of 60% stocks and shares and 40% bonds. The basic answer to this one is the more bonds you have, the more stable your money will be, but the slower it will grow. So I want you to think of stocks and shares are the engine that creates the growth, and bonds are the stability. They're meant to be a very stable thing. You get your X return over the period. That's it. J.L. Collins recommends a 70-30 split when you get towards retirement. There are lots of different things. I think 60-40 is like uber cautious, probably insanely cautious, and you don't need to do that. The more bonds you have, the less growth you have. I would use the financial forecasting workshop to actually work out. I'd put a line in for stocks and shares, a line in for bonds, and then I would work out over the years what happens to my income to see the impact of 80-20, 70-30, 60-40, just to see the impact of what happens. And that will give me more of an idea and more confidence in what's going on. And then I promise we will this year run that drawdown thing where we talk about how to get to those points and the different pieces of those. Awesome. If I haven't answered your questions in the chat, it's because it's moving very, very quickly and I don't have an amazing Katie Wicker to help me on this. So I'm just going to pick the ones as I go that come up. AZ Marie says, what's your view on income protection? Income protection is a fantastic thing. I guess the question is, who are you protecting with it? So Katie and I don't have any kids. We don't have any dependents. And if one of us became ill, we could always live on the other person's salary. So we actually decided never to have income protection because we felt confident in our ability to deal with it. Now that changes maybe if you have kids, if you don't have a backup plan, maybe you don't have godparents, parents that could support you. Like, think about, do you really need it, or is there another support network in place? Which specific risks are you worried about? Income protection can be very, very expensive, depending on like how much of your income you want to protect and for how long. So I would always say, is there another way of protecting against the risks that you're worried about? That's the key piece. And then if you can protect against those risks in a different way, I'd more likely go that route. Okay, that's a quick one on income protection. D says, why give money away when you have an emergency fund? Yes, D, I love that. That's part of the income protection. You've got your own income protection for 3 months or 6 months to find another job. D, you're better than me at answering these questions. I think you should come on live and do it. We're sacking Derek. D's on. Oh, Derek, we can't do that. We love him. Okay. Um, Chris Sevor says, what's the difference in risk between an index fund and an ETF, which is an exchange traded fund? He says, I understand an ETF can be bought at any stage of the trading day, whereas an index fund can only be bought at the start end of the day. That's exactly correct. Index funds have one price per day. ETFs are floated on the market, so you can literally track the live prices and you can invest at any time. For us, in an ISA and a SIPP, like it doesn't really matter. Do whatever you want. We invest in index funds because like we're not really planning, we're not traders, we're not trying to trade by the minute. We buy and leave it invested over the long term. We have learned that in a general account, it is actually quite useful to have an ETF because it allows you to sell it at an exact point and know what you're selling it for, rather than like doing a trade and then waiting till Monday and it might have gone up. You might like have more than your CGT allowance. Like it's actually useful to have an ETF in a general account. There isn't really any difference in risk. Lots of the FI bloggers recommend ETFs. Use whichever ones you want. We kind of go for index funds because we're not trying to trade in and out. There's no real change in risk. Awesome. Okay. So Folake, I hope I pronounced your name right, from YouTube says, is it advisable to take part of equity of one's property to invest in stocks and shares? I have had that question and conversation with my wife many times. And every time I come up with the idea, she says to me, so you want to borrow money to invest in the stock market, Alan? Then she kind of stares at me and I go, oh, you're right. We shouldn't really do that. Um, it's kind of like this is a little bit of semantics because we chose not to pay off our mortgage quickly. We chose to invest instead. So we left our mortgage on the lowest possible payments and we invested instead. But we would never like take money out, equity out. But you could downsize because then you're not borrowing. You've downsized, you've sold it, you've lived somewhere smaller and you've got a chunk to invest. But we wouldn't basically borrow money on our mortgage to invest in the stock market. It feels like a difficult game to play. So we would avoid that. Cool. Student says, do you recommend life strategy funds or should we manage our retirement funds allocations ourselves instead of using workplace providers' life strategy funds? I love students' questions. Life strategy funds. Do you know what I'm going to say? Generally, boo, we don't like life strategy funds for several reasons. One is it predicts your number of stocks and shares and bonds based on your age, which we all retire at different points. So I think that's daft. And two is the Vanguard ones are very heavily weighted in home country bias. So they have about 20 plus 22, some of them more percent of your money in the UK, and they're not globally representative in the same way. So we would avoid it for those two reasons. I think home country bias is an absolutely daft thing unless you live in America, because America makes up 65% of the global economy, so they can kind of get away with it, and their biggest companies are global. But for us in England or the UK or whichever country you're in, maybe you live in Latvia, Norway, do you want all of your money invested in your own country? Like you might be really backing Latvia, but I don't know. I'm not backing the UK. It's not been doing well for a long time. And even if it had, it's a form of stock picking. So you're picking a country and going, I'm backing that country to do better than all the rest. Like, just don't bother. Buy them all in a global index fund and then you reduce your risk because who knows whether the UK, the USA, France, China, Colombia, who knows which one's going to do best in the future. So you just can't pick, student. You just can't pick. Cool. Right. Uh, Raj says, what are your views on the new British ISA? Think I just gave them, Raj. Stay away. Don't bother country picking. Like, yeah, just don't bother. Okay. Vidya, I hope I pronounced your name right, says late to the game, limited company owner for 2 years, 53 years old, and just started to pay in a SIP since joining the Facebook group. Nice work. Incredibly grateful for the amount of information here. Awesome. Has a good defined benefit pension from before. Lots of factors, but would want a decent amount invested across the stocks and ISA and SIP for 10 years to hit a million. Million is a great target. I love it. I'm asking is potentially selling my house soon and want to invest a lump sum in the global developed world ex UK. No plans of retiring fully yet, as already barista fire. Love that. Um, yeah, so like if you want to invest, if you're selling a house, I think we mentioned this briefly earlier, lump sum investing versus dollar cost averaging. Lump sum investing always ends up winning over the long term. So just get your money in the market as soon as possible. It says so far he's got 5K in the SIP, 150 in stocks and shares, ISA, and has a decent emergency fund. Just get the money in the market working for you as soon as possible. If you're going to be working for a while, that's awesome. Sell the house, get the money in the market, let it grow, and you will be amazed at how that grows in the background. It is phenomenal. Phenomenal. Cool. So Maya says, can we suggest any valid alternatives to the FTSE World X UK FTSE Global All Cap? Maya, why? Yes, there are lots of alternatives. You can buy a BlackRock global fund. Just buy a global fund from anywhere you want. That's absolutely fine. There are lots of alternatives. I am curious, like why? Why do you want an alternative? Seems to be a great thing. Cool. Right. I paused briefly because there's been so many questions. Gary says there can be a time when you can be too pension SIP heavy and piling too much in will ultimately delay your financial independence or retirement date. I totally agree, Gary. And that's part of the planning with the finances. You need to get some in an ISA and a general account to be able to get you through. That's just a planning thing, and you are where you are. We just changed the strategy from now. Okay. Angela says, I've now opened Vanguard accounts for my kids, transferred their previous ISAs onto there. I haven't figured out the investing part as they had cash ISAs. Any recommendations for investing there or still broad-based index funds and give it time? I think you can probably all know the answer to this one. Derek wants to scream it into the abyss. It's the same. FTSE Developed World, Global All Cap, buy a global broad-based index fund. If your kid we actually came up with this thing. I worked out the maths. We called it baby fire. If you put 10 grand into an account, like an ISA or a SIP or whatever, it doesn't really matter, for a newborn baby and left it till they were age 65 and it was in a broad-based index fund, at age 65, they would be worth £6.5 million for their retirement. Like it is phenomenal. Just get investing in a broad-based index fund, let it grow, and we are all good over the long run. This is when I start to sound like a broken record, isn't it? But it's fun because like this is the thinking we need to do. Okay. Next question. Kong Wei says, hi, Alan. I'm still intrigued how you guys could reach FI in such short time, less than 10 years. I understand the power of compounding effect, but you must have had huge earning too in order to invest. Love that question, and I will give you the direct answer. Also, I want to say lots of people look at us and then go, oh, they're high earners. That means it's okay for me. I can't do it. Oh, they don't have kids. Therefore, it's okay for me. I can't do it. And they kind of look at us and then they go, oh, like I could never do what they do. Don't use that as a story to trap yourself. You can do anything. I believe in your power to be able to create anything, do anything, and change anything. Never use a story of, oh, someone else did it, like they are like, oh, it's good for Alan, he's smart, or it's good for Alan, he's like whatever, he hasn't got kids, or who knows what it is. Don't ever use that as a story to trap yourself. Now, on to the real answer of how did we get to financial independence? The real answer is we've been setting ourselves up for a long time. I had been studying self-development since I got my first book at 20, 21 years old. I've read every self-development book. I was working on building businesses. I've been focused on this for decades. The actual bit from when we learnt like about finances was about 10 years from 0 to 1 million. How did we do that? There was many things. Number one, index investing, and it grew insanely over the period. Number two, we focused heavily on increasing our income, which we did a whole workshop giving you everything we did to increase our income. Katie managed to triple her salary by going contracting. And then we spent all of that buying our freedom, i.e. putting it into index funds. We kept our expenses down. I drove a beaten up Skoda Citigo. I loved it, but it was a beaten up Skoda Citigo. It cost me £5,000 in total. I didn't have fancy cars. We lived in a 2-bedroom flat in Basingstoke that was particularly cheap. We were trying to look after our health, so we ate like beans and vegetables all week and didn't go out and eat very much. Like we did everything. We actually worked out we managed to accrue about 40,000 just by having salads in as opposed to eating out at lunch. Like it's insane what the little differences make. I do have a chart we show on the course that shows all of our income over the period and how that affected our net worth. We did earn a lot more and we didn't spend a lot. And those two things compounded with market growth. There was one year as we were growing, the market went up by 30%. It was insane. And yeah, so like just go for it. Work on increasing your income, work on keeping your expenses down, invest everything, and you will get there. I promise you will get there. Okay. Now, Raj says, is it easy to transfer cash ISA into a stocks and shares ISA? The answer is yes. So with Vanguard, they have a button that says transfer, and you can transfer in a stocks and shares ISA. There are other providers out there. We actually have our ISA with Halifax because Vanguard's ISAs didn't exist when we started. So that's an easy question. Yes, it's very easy. Might take a little bit of time, but it's fairly easy. Tracy says, will you be introducing any new Excel trackers on the new course? Are the latest shown on the resources page? The net worth one and the wealth building one. I am sure Katie will create a new version this year. Every year we improve things, we make it better. And I'm sure Chris Andrews is awesome. He goes, I'm still using the old school one from Take Control of Your Finances 4 years ago. I love that. Our own net worth tracker isn't as good as the one Katie has created for you. So I'm sure there will be a new updated and improved version this year, but the ones you've got will work perfectly and you can tweak them as they go. Awesome. Okay. Are there any questions that I have missed? Anything that I have not answered? Veronica asked the question, hi guys, you travel so much, what are you doing about health insurance? The answer is we bought an 18-month backpacker travel insurance before we left, and it's about £100 a month and covers for everything as we travel. So that's what we did. Before that, we used something called Safety Wings, which is a nomad travel insurance. So we do have health travel insurance. It's interesting because you get one price for the world and then you get one price for the world plus the USA. And it costs you a lot more if you want to include America because it costs so much for health there. And so you can travel the whole world for a cheaper price. And if you want to go to America, it will cost you more. But that's a fairly easy solution. Cool. So Sarah Dodson says, "Hey, Alan, can you talk about the exit strategies, please, with regards to investing? I'm curious from my personal point of view and that of my 10-year-old son, finding the balance of living for now, putting away for the short, medium, and long term. I would want to have a clear plan as possible for him so that I continue to educate him about managing the finance long term. I would say he's 10, he's got a little bit of while to have an exit strategy, but it's nice that you're thinking long term. I did actually want to give you all one very important thing. So we were sat with a friend at the economy conference in Cincinnati, and he was telling us about his strategy to get comfortable with drawing his money down. And he created with his wife what he called an investor document. And his investor document basically says, we will invest in broad-based index funds, and we will do it in these proportions. And I think his was 80% stocks and shares, 18% bonds, and 2% cash. And then he said this little hack in his mind means he doesn't feel like he's doing something bad by spending his money and selling off stocks and shares. He just has to rebalance every 3 months to make sure he's at 2% cash. And he does that by selling off. If stocks and shares have grown massively, then like that will be what you sell off to bring it down to 80%. And then you put that into your cash and you spend that cash. If stocks and shares have gone down, then you would sell off the bonds to top up your cash. And then you stay in those proportions over the period. And that's how he does it. And it was a wonderfully simple system that he uses in his mind to enable him to sell off those items. And he's like, I'm just rebalancing. I just rebalance every 3 months so I have enough cash in my account so that I can live and do whatever I want. And he sent us his investor document that he created with his wife, and we're going to use that to create something for this year's course to add into it, because I think it's actually a wonderful, simple concept that would be good for us all to use. So I think that kind of answers that one a little bit. Carla says, hi, will you cover the ethical, sustainable angle RE index funds we're proposing discussing in the course? Yes, my overall thought, and there are a lot of people, you can search this to back this one up, is that ethical investing doesn't actually make that much difference to the companies themselves. What makes a difference is our spending. So if we all decide that, I don't know, pick a company we don't like. What's a company we don't like? I don't know. Name a car. Can't think of one now. One that produces something very bad. Tahir says Shell. Maybe it's Shell. Who knows? We'll pick a petroleum company. We'll pick whatever. If we stop going to Shell petrol stations and spending money with them, how quickly will they change their behavior? Like overnight, because they don't have the income. If we don't invest them, do they care? Actually, there are some articles coming out now because the sustainable funds have withdrawn money from companies like Shell and BP. They don't have the money to be able to come up with new energy sources for us. So it's interesting. There may actually be a negative downside of ESG investing. But we can discuss that for a long time. There's some economics and maths around it. The best thing we can all do is spend our money ethically and then focus our investing just on a simple broad-based index fund, because that will rebalance to reflect the companies in it. And the companies that we all spend our money in will be the most successful ones. They'll make most of the index fund, and the market all works itself out. So there's a quick answer on that. We did a lot more work on it, and we did all those things. Okay. Liz Hodge says, do you have any advice for the boring middle of working towards FIRE? So you have direct debit set up, you're over the excitement of FIRE. Liz, how could you be over the excitement of earning money and doing that stuff? But you have a number of years before you will actually be able to retire. Do I have some advice? Yes. Live your life. The whole purpose of setting up your finances is so that you can live your life. Do as many things as you can with your family, create cool events, have fun, do stuff, volunteer. The whole purpose of money and finances is for you to have the life of your dreams. Once you set the finances up, live your life. Do you have any nice friends you would like to spend more time with? Could you organize some picnics, play some board games, organize a trip? Please live your life. And I don't know if anyone remembers, we had this wonderful guy who had exactly the same questions like, what do I do? I want to go faster. I want to do this. It's like, I'm in the boring middle. It's like, well, you can focus on increasing your income. You can focus on doing all sorts of stuff. You could launch a business, or you could enjoy your life. Just live it. That's the key bit. Okay. And then we had a concept from the McFlips, or an idea from the McFlips. McFlips actually got your email. I loved your question. And I was trying to figure out exactly what you were trying to ask me. And it was about the safe withdrawal weight and all those things. His question in here is, can you talk about life hacks, concepts you utilize to bring down your expenses, such as loyalty programs, rewards, house sitting, accommodations, income from side hustles, etc. So Katie and I are not living off our full 4% of our portfolio because we still earn money. I wasn't expecting that. I built a business that was successful. That still pays me an income. We do other things. So we still have an income that enables us to do stuff. Christy and Bryce from Millennial Revolution actually did what's known as a pure test. So they had what they call Portfolio A and Portfolio B. And Portfolio A was their like million Canadian they retired on. And then they said, can we continue to live off this? And then anything they earned in retirement, they put it in Portfolio B so that they could prove that they were able to live off the first one forever. So look up their stuff on that. It's actually very good. They've done a pure test and they can do it. How have we done it? We still earn some income from Rebel Business School. We turned on YouTube monetization, which they will show you adverts even if we don't take the profit from it. So we didn't feel too bad about it. But we made £1,000 from YouTube last year. We're YouTube millionaires. I use hotels.com, which gives me 1 out of every 10 nights free. We try and search for the best prices on flights. Like we do all of those things to try and reduce our expenditure as well. I guess the main one is, you may have seen on my Facebook post that we went to Disney World recently for Katie's 40th. We had the most incredible time, but it is so expensive. It is so expensive. So we will live in South America for 3 months afterwards because it is so cheap. It's unbelievable. The difference is unbelievable. So 3 months in South America will easily afford us a month in America. And we kind of balance that out in our head. Maybe we'll go to Thailand to save some money. Boo-hoo, poor us. We'll go and live on a beach and be a little bit wealthier afterwards. But that's kind of how we do it in our head, is we adjust like a month of living in an expensive place with some time in a different place, that balance it. So there's a few of the concepts. We probably don't do all of the hacks because credit card hacking and some of the travel rewards just works better for American people and Canadian people than it does British people. And we don't have access to the same reward schemes that Americans do, which I think is very unfair. Very unfair. Okay, I'm going to do a couple more questions. I know I haven't got to all of your questions. I'm really sorry. I will look at them afterwards and go through them all, and we can work it all out. So I'll just do a couple more and then we'll move off. Alan says, what does FIRE assume about your healthcare needs in retirement? NHS are doing the best that we can, but we know diagnosis and treatment can be very slow versus private medical. Alan, this is something that we all have to decide for ourselves. In America, you have to have private insurance. In the UK, we can talk a lot about how the NHS is trying its hardest, but just doesn't have the resources to be able to deal with things. We don't have private cover at the moment. We have our travel cover. I actually broke my hand in Colombia. And can you guess what the entire bill was for the best doctors in Colombia? Uh, like I had the cast, they did the x-rays, they did all the stuff, they looked after me. What do you think the bill was in Colombia for the Beck doctors? D puts £30. It was slightly more than £30, D. I think that's like ruining my punchline, but I still love you. Angela's 100. It was $300. It's like $300. And like I know there are big things, but those big things we need to think, do you need that insurance as you get later in life? Are you relying on the NHS? What are you doing to look after yourself? And I actually think it's a fairly personal decision. I'm 45 at the moment and I'm working very hard to be healthy and fit. So I've got a while probably. I hope. This is a difficult one, isn't it? Like I hope I have a while until I have anything go wrong. But we'll see what happens. So I've got a while to make those decisions, and we all need to make different decisions as we go forwards. So hopefully that helps. I love that Derek put in the YouTube chat St. James's Place was the evil company. Derek, I love that. Yes. Let's all take away our money from St. James's Place and then see what happens. They will react very quickly and change to do a different type of investing with lower fees because they don't have any income. Whereas if we invest in them or not will make zero difference to their future. Okay. Garimpo says, hi, Alan. What about bonds to keep your balanced portfolio? Garimpo, I answered your question at the start tonight. If you're 39 and you're not retiring for a while, you do not need bonds. That's it. Free to guess £350. You were more or less right. Okay. So I think we are pretty much there on the questions. It has been an intense night. We've done 72 minutes of Q&A. YouTubers, I love you. Thank you for coming along. You are incredible and I love spending time with you. Zoomers, you're amazing. Come to Rebel Finance School if you would like. And if I could ask one favor, please tell everyone about it. Your kids, your nephews, your cats, your dogs, get everyone on Rebel Finance School because we want to help them all improve their finances and to get going with their money. That's our mission, to help as many people as possible. So please help spread the good word of looking after your money and living your best life. Okay, I'm going to end the stream on YouTube. I love you all. Thank you for coming. If I haven't answered your question, I'll have a go at getting to it. YouTube has now gone. We love